The concept of margin leverage is ambiguous in forex trading. What exactly are leverage and margin? The short answer is these two terms are each different sides of the same coin. Here, we're going to further detail, starting with margin. In summary, the margin is like a deposit requirement that becomes locked up when making a purchase, such as when buying real estate, but in this case, it is to open a forex trade.
The down payment in a real estate purchase might only be 10% of the value of the property. Thus, the margin requirement can be thought of as a percentage down payment towards the overall transaction value. In financial markets, this concept of margin is similar, except that if the value of the trade changes rapidly, you might need to deposit an additional margin in the broker account to avoid having your position liquidated, known as a margin call. Leverage simply measures how far your margin can go in terms of controlling transaction sizes. For example, a high margin requirement will mean less leverage, whereas a very small margin requirement will mean that you are getting a higher degree of leverage considering the size of the relative margin needed to open the trade. So, a trader looking to purchase 10,000 units of the GBP GPY currency pair at an exchange rate of 143.21 Japanese yen for each unit of British pounds and at a margin requirement of 10% will have to use the equivalent of 143,210 GBY as margin based on the trade value of 1,433,100 GPY equal to 10,000 British pounds. In other words, the trader needs at least 100 GBP to purchase 10,000 GBP relative to the other currency. This is a form of 10% margin equals to 10 for 1 leverage. It's important to remember that the lower the margin requirement and the higher the associated degree of leverage, the higher the risk is of losing all your money.
Leverage in forex trading is like a credit mechanism that allows forex traders to take positions, whether buying or selling, which is of significantly higher value than the funds that they have available in their account. Leverage also provides a solution to hedge an amount in your portfolio by using only a fraction of the available cash balance. Most of the brokers display that information on the trading platform. You can see here some more examples.
The amount of available leverage varies wildly among forex brokers, and you can have a very different result if your margin is 50 for 1 compared to 400 for 1 in the forex market. A margin requirement of 25%, which is 400 for 1 leverage, provides 80 times more leverage when it comes to potential earnings or losses compared to a 2% margin, which is 50 for 1 leverage. In practice, leverage reflects the fact that a broker lends investment capital to traders who are in effect borrowing the leverage amount using just their margin deposit as collateral. Therefore, this mechanism allows you to reap larger profits if you achieve good performance, or larger losses if you don't manage your forex trading properly. Overall, using leverage is not for everyone as the potential losses it can generate can be significant. Extreme caution is required when using leverage, along with a good understanding of the margin requirement level, as that will determine the degree of leverage. We can think about leverage as a notion of risk because smaller margin requirements mean bigger degrees of leverage, which causes more sensitivity to risk when the underlying prices changes. Some positions can even lead to losses larger than the total amount available in the trader's account, causing a negative balance.
One useful tip is choosing a forex broker that has a mechanism that automatically closes positions to prevent bigger losses when your available cash reaches zero. It can minimize the risk of negative balance. For reasons such as this related to the risk of using leverage, it can be prudent to use little or no leverage, depending on your trading strategy and goals.